Good evening, ladies and gentlemen. You are watching the Stock Market Brief Show. I think it's safe to say that everyone was expecting a bounce at some point in the S&P 500. Last week, we followed this trend line almost precisely, and to start off this week, we gapped above it, traded around it, and we've been continuing higher up into and around the weekly expected move. Now, in today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis, we got to dive into what's coming up here in the near future as far as macro reports go, as far as earnings go, and what that means for the S&P 500. I mean, we saw the bounce was going to take place, so we'll revisit as to why that may have been the case. But is there going to be legs to this, and is this going to go back to all-time highs, or are we going to continue to see volatility? So all that and more on today's Stock Market Brief Show. Let's go ahead and get into it. All right, welcome back, everybody. Before we hop into all the charts, I just wanted to thank my Patreon community for supporting this channel. It's $9 a month. You get access to the Discord, and that's where I post a bunch of different various types of information. We have Tradie Tick suite of Discord bots there where you can also type in the query channel and get all types of cool information there. There's a help me file pinned in that channel. You get access to the community. We do monthly, weekly, daily expected moves on products. We have the zones, which is a indicator that was built by Joe Catanzara. I just built it out into a cool document way to see things. And then I give my watch list every week and some various trade ideas there too as well. It's not only the Patreon community that's been supporting me, but my partners as well, Interactive Brokers. Make sure to go check them out. There's a link in the description there. This is an award-winning platform. They're also working on a platform right now that really kind of looks and feels like Webull, but it could be very well a big competitor. So you can get in early to that to get access and see what it is. They're integrating TradingView, which is very cool. They also have an campus here too that has a bunch of free resources like courses, stuff if you want to learn options, if you want to learn advanced option strategies. They have webinars, and that's all provided for free, which is very cool. So thanks again to the partners and the Patreons there that support this channel. It allows me to put out free content. It's a big deal here because unfortunately YouTube ain't cutting it. All right, take a look at the calendar here for the week ahead. So tomorrow we got some durable goods orders. The following day we have GDP growth rate, some pending home sales, and then the following on Friday, we get core PCE data, personal income, personal spending, and then Michigan consumer sentiment. So we do have quite a bit of macro data drops, but it could be kind of shadowed here a little bit. The earnings is casting the shadow. Today, after the close, we had Tesla and we had Visa, so we'll visit those very quickly. But we also have, coming into tomorrow after the close, Meta. It's going to be one of the bigger ones everyone's going to be paying attention to. We have Boeing before the open. We have IBM after the close. And then we also have Microsoft, Google reporting this Thursday here after the close there too as well. And then come Friday, we have a lot of energy names reporting earnings. So we have overall just quite a bit of stuff to come out while the market's already made a significant rally these last couple of days. Now, Tesla reported after the bell, and the market likes what it sees. I'm not going to dig too much into that, but the market priced in roughly about a $15 expected move. And you can see as it stands at this current moment, we are trading just at that earnings expected move. Visa also reported after the bell, and it came right into its earnings expected move there too. Understand now why the earnings expected moves are so important, because if you understand these going into the earnings, you have an idea. If you're in the position or taking a position, you can get a good idea of as far as a risk goes per share, and it'll really help you determine, your sizing, your position sizing, potentially a strategy, or if you're in a position already, maybe you might want to move stop losses up and or take profits, just mitigate the risk in some form or fashion. Now, today's price action was kind of interesting. We had a rally in the markets. It was pretty strong. But take a look here at U.S. sectors and factors of what performed best. Over here, you have the ARK Innovation ETF, and then you have the short basket leading the way. So it's interesting that the market sold off, and then the bounce recovery is being led as it stands right now by a short basket, heavily shorted name. So is this a short covering rally that could potentially run out of steam? Now, towards the end over here, you can see what got hit. Well, the volatility of volatility came off. So the VVIX, we had SKU come off a little bit, and then we had VIX there too, which is the S&P 500 volatility index. Now, as the market was selling off, one of the big levels we like to look at is these quarterly moves and even the monthly expected move. Now, as we were coming down in here, one of the levels we wanted to pay attention to was that monthly 5 EMA, which is at 49.83, and the lower quarterly expected move. And we came darn near with pristine precision right into and around those levels. And these last 2 days, well, we started to bounce. Now, if you look at the weekly time frame, we had mentioned that if you get overextended on the weekly 5 EMA, it's very likely to get snapbacks. And you can see we got pretty extended over here in October and we saw a snapback over here. It ended up leading to a rally, but you can go back through history and see when we undercut it or when we overshoot it, it's likely to consolidate or snap back to get these moves back into that weekly 5 EMA. So now we can look at about 50.90 to 5100 range. If it comes back in, we'd be coming back into and around that weekly 5 EMA. But overall, we'd be trading what? Inside the prior trading week's candle, right? We expanded to the downside and now we're contracting, meaning volatility, historic volatility, right? The high and the low of the candle or the body you can look at is contracting within the prior trading week. Now, another thing that gave us insight to this was looking at smart money versus dumb money. So the HYG we'll call smart money, dumb money we'll call the S&P 500. Back in October, we saw also that the smart money was putting in a higher low while dumb money kind of flushed lower. And this gives us insight to potential changes in trend, potential bounces in the market. And what we see here is, well, HYG put in a higher. This was actually on the day that this was down pretty significantly on SPY. We're flushing in the end of the week into and around this area over here. And as we were flushing down there, the H high yield was actually up on the day, giving us some insight. Hey, maybe perhaps the market may bounce. Well, come into this weekend, guess what? It resolved itself to the upside. Does this mean it's going to go all the way up and keep moving up? No, but it did give us insight there of a potential change. Not only that, we also had the percent of stocks in these various indices above their 20-day moving average reaching critical levels, as we pointed out on the prior episode. And what do we see happening now? We see them moving out from that oversold condition back into more of a normalized territory, not overbought and not oversold. Another thing that we paid attention to is the RIDEX asset ratio minus bear. So this is basically telling us very quickly if it's going down, right? If it's going down, things are pretty darn bullish. And when it goes up, things can be very, very bearish. Okay, so it's a little interesting to read there. But as you can see, these spikes over here, big spikes, when we got extreme bearishness, you can see the market was hitting extreme lows and we kind of came out of those. And the reason why we call this out over here was because we didn't see this low of a reading, right? This extreme bullishness of a reading since pretty much 2022. And the reason why we called it out is because you can't really act on it, but it's a sentiment. So it could be a kind of a contra type of move. When things get too bullish, they may turn bearish for a little bit. And you could see we actually sunk off in the market, the S&P 500 from that point as it started to normalize itself slightly there a little bit. So there was a lot of different things taking place. We had the 5, 10, 20 timer, right? This is just looking at the 5 EMA, 10 EMA, 20 EMA. They all crossed over and we saw some follow through to the downside. And we're still not quite there covering those, the 5, 10, and the 20. You'd want the blue line above the red line, above the green line, like so, where it trends up. And right now we're just bouncing back above the 10-day and coming in around to the 20 EMA, which is roughly at about 5,100 on the SPX. Another thing that we like to look at is various intermarket assets. And you can see here, what I find very interesting is the month-to-date column and the week-to-date. And the reason why I want to show this is because if you come down here to the week-to-date, notice the things in red. The 10-year yield, the dollar, you have copper, you have gold, right, and silver down there. So these are some big intermarket assets. And the 10-year and the dollar I'm kind of putting focus to, because if you go now to the month-to-date, so as these are red for the week, what's green? You have most of the market, most of the products all in the green. But if you go out here and you look, take a look at what's green for month date, 10-year yield and the dollar have actually caught bids. And what has that been doing? It's been putting pressure on almost everything from a month to date perspective. So when you look a little bit, this is the shorter term, but the longer term, right, month to date right here, you can still see that there's a pressure applied to all types of markets, right? Semiconductors is still down 7.64% for the month. Bitcoin's down, or BITO is down 10% or so, right? Regional banks is down 3%, even though that it's making a big, 3-day rally over here. Technology up for the week, but it's down 5% for the month to date. So these are really interesting types of assets to closely pay attention to. And if you look at like the S&P 500 and its correlation to the long-term treasury yield, the light green line here is the 10-day, the darker line is 30-day, so we're just looking at different correlations. We were looking at a positive, but it's back to negative. There's almost no correlation really here. It's more correlated when you get these extremes, but it is a negative correlation, meaning if the 10-year yield wants to rise here, or 20, 30, whatever, these long-term treasury yields want to rise, it could put pressure on the markets. Another interesting chart was looking at the VIX correlated to the long-term yields, and there is a pretty strong positive correlation here. So if yields want to continue to go up, perhaps that's insight telling us, hey, we might actually see volatility continue to rise and see that throughout the marketplace. So it's always important to look at that, and then you can look at the absolute value of these yields. So if you take a look at like the 10-year yield or the TNX, right? So, it reads over here at 45.98, which means we're at almost 4.6% on the 10-year yield. It's came off a little bit here. Still a positive look on the PMO, but it's starting to kind of roll over as we're just consolidating. So is this consolidation, is it going to resolve itself to the upside? Well, if it does, that can, once again, put pressure on the markets, potentially increase volatility in the markets, as we just priorly discussed right there. The 2-year yield, which tracks the federal funds rate a little closer here, came off today, but it's still floating around that 5%, just consolidating, which will be interesting to see, because if the reflation trade is back and inflation is going to continue, we can look at assets like oil and so forth here momentarily, but is it going to start looking like, this going to start moving back up to where we saw in 2023 at its 5.2% reading? And right now, it looks like a bullish consolidation, and it's just going sideways. And if it tracks the federal funds rate, it's always important to look at Fed fund futures. You can see here, we're not really pricing in a rate cut up until September, which still looks like a coin flip. So if the inflation still continues to be hotter than expected, or, flatline and remain high, this could tell us that rates are going to continue to remain higher for longer. Remember, the market had like 6 rate cuts in, or 7 for this year. Then it would have like 4, and now it's down to 1, 2, and potentially less, depending on some of these new readings that come out. Now, all that in mind, as far as the bond market goes, you can take a look at the yield curve. We'll look at the 10-year, 2-year, and then also the 10-year, 3-month. And these have been inverted for some of the longest times that I've seen. I'd have to go back through some old school charts to see how long inverted yield curves typically last. But this would be probably close to one of the records, if not a record. I'd have to go check. But we are still remain inverted, and there's going to come a time where we uninvert, and that could be during the time where we eventually cut rates. And typically when we uninvert, that's actually when the market sees more turbulence. And I've shown that in prior videos as to why that may be. But from looking at the S&P 500, looking at yield curves, looking at the uninversion, and also looking at the federal funds rate. So I'll bring that up another day if you haven't, there on prior videos. If you take a look at the dollar came off today, which does help the S&P 500, right? We've been talking about that negative correlation between these two assets. So as the market went higher right here and now is going sideways, you can see the S&P 500 did get hit to the downside, and now coming off today led to a nice rally in the S&P 500. And overall, what are we doing? Are we going to be coming off a little bit further here? Are we going to come retest this breakout area over here? And then is that going to help perpetuate the market higher? And is that going to be just put in a higher low? Hey, you never know. We'll look into a little bit more details here momentarily. So the S&P 500, the SPX, we had 6 days down, which is very rare. It's happened 3 or 4 times in the last 5 years. And we're starting to see a reflexive bounce. So if we bounce up higher, which we do have some stuff signaling that we're going to have a higher high, higher low come tomorrow, which I'll go over here momentarily. But if we go higher, remember, we're below a 50-day moving average that's starting to flatten out. We're below a declining 20-day. And then also to note, we're potentially could come back into a trend line like something like this, where even if we come up higher, it could get potentially rejected. Now, doesn't say that's going to reject, but that does come in line with the 50-day, the 20-day, and this area after a strong move. What we would need to see is some sort of consolidation. What you'd like to see is a pullback, a consolidation, and then put a higher low and then break to a higher high in the near term or the short term to potentially go retest these highs and go higher from that point. But a move just like this, it's going to, a lot of people would miss a rally like that. Okay. If we continue on and look at the 15-minute chart, we are already outside of the upper weekly expected move. So the likelihood of coming back in this, that is the higher probability. Doesn't mean we can't come outside or up a little bit further, just like we did in the prior trading week, how we got below it, came down, and we came back into it and so forth and just kind of traded in and around it. That's very typical to happen. Now we're still below the monthly lower expected move for SPY, but we did come back with a vengeance today, coming back into and around that level. Starting tomorrow, our daily expected move is up at around 508.86, and the lower daily expected move is 502.44. These are the expected moves based off of implied volatility. So what I would like to see now, because I did trade this up these last couple of days, I did have a position just in the S&P 500, and I trimmed throughout my live show today, and I can't remember if I got fully out or if I have a little bit of a position left. I still have exposure into the market, but I don't know about that specific position. But I did trim during the live stream. Now, what I would like to see is a pullback into and around the lower daily expected move, which would bring us to an interesting area. It would bring us to this swing low anchored VWAP from April. Okay, so that's the swing low, and that's in confluence currently with the 5-day moving average that's starting to neutralize. Remember, we said be patient, wait for this to neutralize and turn up, but also understand where prices come from in these last couple of days. Doesn't mean it can't go higher, but it can and will consolidate at some point. And then you have the week-to-day anchored VWAP there too as well. So all this in this area, you have the daily expected move, the swing low, the 5-day moving average. As price pulls in around this area, these can start turning up. But if we do come down into this area, that could be a potential area to look for strength after the dip. If that were to happen after the dip, to see strength to see a continuation, and that would be quite a positive. Now, if we have a gap up, just look at and watch the lower EM for the monthly, and then obviously the daily expected move there too. Now, if I pull up Vantage Point software, this is predictive artificial intelligence software, and it gives us a range for the following day. It's using intermarket analysis. It's a neural network, and it's pretty cool stuff. And I've had it for a long time, but I don't really use it. But I figured I'd show it today. Maybe some people like it, maybe some people don't. But I'll just use it for the SPY today. And you can see here we did start getting more of a bearish triple cross. It's called a triple crossover, using their predictive moving averages. And it did follow through to the downside when we started to see this red. Now, into and around these lows, we started to see these actually turn up, which is the long-term differential, medium-term, and short-term. And in short, what's it predicting for tomorrow is you have this predicted range, and that predictive range brings us up to and around 508.76, and the predictive low is 502.33. And that's pretty much closely in line with our daily expected move. And we have all these lines pointing up with a neural max that is green, which indicates that we could see, just like here today, it turned green over here. It tells us that the next couple of days could be positive price action, and it says that they have about an 80% accuracy rate. I don't know if that's necessarily true or not. I haven't seen the test, but they do have them available. And if we do come up there to that 508.76, that's also in line with the T-cross long, and those have acted as levels of support and resistance in the past. So that would be a level to be paid attention to. So if we gap up into and around that area, I'd be a little bit more hesitant because it made a strong move, and maybe perhaps it pulls off, and then we see what price action does after that digestion. But if we gap down and see strength after that, that could be potentially a positive sign. Now, as this is all happening in the market, I want to take a look at some longer term and shorter term. So we'll start with the shorter term relative rotation graphs. And from the very short term perspective, the last 5 trading days, I do want to call out that you're seeing relative strength in utilities, consumer staples, and then improving in healthcare. So you're seeing the longer tails, thicker tails going into the leading quadrant or improving quadrant. And these are 3 really defensive sectors. And so as we're seeing these last couple of trading days, right, I go back 5 trading days, yeah, the market's moving up, but also from a relative standpoint, we're having defensive names starting to gain momentum here. And that right there is actually more defensive than anything. And that's a little bit more of a red flag for this bounce. Now, if I zoom out further and I look at, say, hey, the last 5 weeks, take a look here, you have energy obviously making a big move from in the improving quadrant, big thick blue line tail going into the corner, into and around the leading category. And you have utilities making a move there too. Consumer staples is a shorter tail, but still you're seeing some relative power there. And then XLB as well. In the quadrant that's leading is XLI, but it's not really going anywhere. It's kind of been in the leading for the last 5 weeks or so. And then while this is happening, what are you seeing happen here? You're seeing a rotation out of tech and into more defensive posturing. Even from an absolute standpoint, we've been seeing a rotation out of tech and into things like financials. Okay, so short term and long term, we're starting to see this kind of interesting shift take place. And the reason why I'm bringing this up, especially energy, is because when energy performs, when it's one of the stronger performing sectors, right, this typically means that we're nearing and or at a market top. Now, this is more for like cycles, but I'm showing you in more of the short term. This really gave us insight in 21 going into 2022. We talked about this over and over and over again because energy was the top performing sector. And then these three started performing good: utilities, healthcare, consumer staples. And then into 2023, we saw these start to perform very good, which marks the market bottom. Okay. The orange is the market, and that's obviously front runs the economic cycle, which is currently the blue line. So I did want to point that out because we've been showing this chart more frequently, which is the rotation, the relative strength line between energy and the S&P 500. And when the energy outperforms the S&P 500, you typically get the S&P 500 to get weakness. And well, it's been going up, and the S&P 500 continued to press higher and higher. But guess what? It finally caught on, and then we saw that sell off. So was this move in energy and this rotation into energy or oil, was that giving us insights? Was this relative strength line giving us insight? And I would say, yeah, this move was giving us insight that we could very well see weakness based off of what we've seen there in the past. So what is oil doing right now? Well, oil actually saw a pretty big recovery, right? We saw some sell-off there into and around the 50-day moving average, and it closed darn near at the highs. And if this wants to continue to move higher, this is also closely correlated to the 10-year yield. So if oil continues to move up, hey, maybe that means the 10-year yield could press higher too, breaking out of that tight consolidation. And as we already know, there's a negative correlation to the market, which could bring, once again, more volatility into these markets. So just interesting data overall. Overall, though, we're kind of just bouncing back from oversold areas. So we'll continue to monitor and see what happens there. I'd be paying attention to maybe this trend line as it's been rejected multiple times. So even if it comes back up here, is it going to get, potentially rejected again? I don't know, or breakout. We'll continue to monitor that and watch that because a lot of energy names look like they just pulled back a little bit and they look like they're setting up again for another run. Let's look now at the gamma levels on the S&P 500. So we're above a rising above a 5-day moving average. It's neutral, so it's bullish, but with caution up until it starts to turn back around. And then we're also in negative gamma territory in this current moment. That can update tomorrow. And when we're in negative gamma, you see selling into selling, buying into buying, selling into selling, buying into buying, selling into. So you see a lot more aggressive type price moves. And what are we seeing right now? Well, we're seeing a pretty aggressive move up into and around the local resistance, which is actually, I believe, the current call wall, 5,100, and next to and around that gamma flip line. Now, understand the gamma flip line could be a zone. It's not always exactly, but because a lot of people aggregate their data differently. So if we get above it, that could be positive gamma territory. And that what that tells us is dealers will look to buy the dip, sell the rip, buy the dip, sell the rip. Remember, when we were in a little while ago going into negative gamma territory, we stayed there for a day and then came back up and we went to positive. So we want to see how it breaks. Okay, and see really what takes on there. Now, if we continue to the upside, 5150 will be an interesting level because 5150, we saw a lot of price action get lodged in and chopping around these areas, and even over there at 5200 too. So this zone in here, is a dangerous spot here, right, of potential resistance as price is still below it. And looking back through history, we've gotten chopped up into that area. Okay, if I pull up just a net gamma chart over here, you can see. Sorry, I hear somebody. It's my kid. 5,100 over here is the call wall. The put wall is 4,900. So if price continues to move through and up and around 5,100, but yet traders aren't really reaching out further, price can kind of come out and then come back in and come out and come back in and kind of get pinned around 5,100. I want to take a look at a couple other 15-minute time frames. This is the Qs. So Qs doesn't look quite like the S&P 500, right? We're above the 5-day moving average, but what's it doing? It's actually still declining here. As we press higher today, there was a negative divergence that formed there on the shorter time frames. So if we come down, see if it, if it comes down and comes back up or whatever it wants to do, but the 5-day moving average, you'd want to see it start to turn back around to be a little bit more positive. So, and then the Dow Jones, this one is starting to turn around, but I will note, as it's pressing higher here, we have a negative divergence there in the RSI on the 15-minute time frame. So we broke this trend line, positive, 5-day moving average is turning around, but I wouldn't just say, hey, yeah, I'll go along here. Wait for the consolidation, wait for it to resolve and for the 5-day moving average to catch up. And then maybe it sets up for a nice move to follow through to the upside. And then IWM also starting to turn up here too as well. We get this move into it, tight consolidation, boom, tight consolidation, boom. And you can see we had a little bit of a negative divergence here too, and it played slightly out there. And now it's already made a very aggressive move, breaking out of this tight little wedge, that had a positive divergence. A lot of these positive divergences were forming. And now it's going to be interesting to see how this consolidates and if the 5 days, really does start to trend up a little bit further. So a couple of positive signs over there in the markets. I think we're at a point where we need to be very patient, right? If you're chasing it, just be careful because we're still technically in negative gamma territory. And if you want to see a potential target, I'd say see in and around this 5,100 where the 50-day, the 20-day moving average are, and there's also this trend line, and that's also in confluence with that gamma. That's where the upside targets would be. And you'd really want to see consolidation after that point, pull back, a higher low, and then eventually a higher high. And that is what you'd want to see in a much more bullish market. That's all I got for you on today's episode, everybody. See you later.